Imagine two dividend-paying investments. One pays a 5% dividend yield, the other pays 10%. If your goal is $1,000 a month in dividends, the 10% yield seems to help get you there with half the money. It feels like a shortcut. But what if that shortcut ends up reducing your income, hurting your capital, and pushing you further away from your goal? Let's walk through a simple example. If you invest $10,000 at a 5% yield, you might receive around $500 a year. At a 10% yield, that becomes around $1,000 a year, and that's twice the income. On the surface, the answer looks obvious, but dividend yield is only a snapshot of the past. It tells us how much income the investment has paid compared with its current price. It does not tell us whether the income will continue. It does not explain why the yield is so high, and it does not tell us what may happen to our original $10,000. So when I see a high dividend yield, I will put it through three simple checks. The first check is the yield trap. This is critical as we want to know why is the yield so high. Imagine a company pays a dividend of $1 per share. When the share price is $100, the yield is 5%, giving you $5 per share. But then the share price falls to $50, the dividend it pays is the same at $5 per share, yet the dividend yield is now shown as 10%. You see a higher yield not because the investment suddenly pays more dividends. The dividend yield is higher because the market price fell by half. Sometimes that lower price may be an opportunity, but sometimes the falling price is a trap. The business may be struggling, its profits may be falling, it may have too much debt, or investors may believe that the dividend cannot continue. This is why a high yield should not always feel like a reward. Sometimes it is the market raising an alarm. Next, at check 2, it is the check on dividend sustainability. We want to know, can the payout actually survive for the long term? A dividend is not guaranteed. A company needs enough earnings and cash flow to keep paying it. A fund also needs a sustainable source for its distributions. The yield shown on a website may be based on what was paid during the previous year, but we are investing for what may be paying in the future. Suppose the investment currently shows a 10% yield. You invest $10,000 expecting around $1,000 a year, but the dividend is later cut by half. Your expected income falls from $1,000 to $500. Suddenly, that 10% opportunity is producing the income you could have expected from a 5% yield, except you may have taken more risk to get there. And dividend cuts can create another problem. When income investors lose confidence, the price may fall even further. So the investor may get hit twice, less income, and a lower investment value. Last but not least, this is the third and final check, the check on capital impact. We need to understand what is happening to your initial investment value. Let us return to that $10,000 investment example. You receive $1,000 in dividends during the year. That feels like good progress. But if the investment falls from $10,000 to $8,000, the full picture looks different. You gained $1,000 in dividend income, but the investment lost $2,000 in value. The dividend is real, but so is the decline in your capital. This does not mean the price drop is permanent, as it may recover or even grow, but it shows why dividend income cannot be judged alone. If I am building a cash flow machine, I do not only want to see how much cash is coming out, I also want to know whether the machine is slowly wearing itself down. Don't get me wrong, a high yield investment can still be really good investment. Some investments naturally offer extremely higher income because they carry different risks or give up some growth, and some investors are all right with those trade-offs and accept them. So the lesson is not that high dividend yield is bad and low dividend yield is good. A lower yield can still come from a weak investment, and a higher yield can sometimes be sustainable. The useful lesson is this: yield alone cannot measure progress. When you see a high yield, you should ask three questions. Why is the yield high? Can the payout be supported? And what is happening to the value of the investment over time? A 10% yield may produce twice the income of a 5% yield, but only if the payout survives, and only if the change to the capital does not cancel out the extra income. This is not financial advice, but when the potential dividend income seems too good to be true, be extra careful. Here's a question for you. When you see a high dividend yield, what concerns you more? Getting an income cut or the possibility of losing your capital?